Good evening. It is much later than normal, uh, honestly, because it took me a while to figure out what to say. It's a lot to process, a little more than normal to process. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective channel here on YouTube, where I help you make your dreams a reality. Um, Talking more about closed-end funds and methodology as we try to figure out the best way to manage the stock market. Uh, the closed-end fund method we use is just one piece of strategy and how we're going about accomplishing our dreams. If you want the full methodology and the 12 steps to financial freedom, then head over to Facebook and search for Adapted Perspective, navigate your finances, and check out my group and the 12 steps, which are in daily post at the moment. There's not one consolidated post about the 12 steps, but it's I've been talking about that every day for about the last 2 months. Um, so reminders, this is an unedited video. As you can see from the background, it is not the best lighting, and that is a real bookshelf behind you. Um, but it's an unedited video. So who knows what you'll hear in the background as I film these in my house. Hopefully not much, because the rest of the house is asleep. Um, but I like raw, transparent, authentic, unfiltered video where you get to hear all my mistakes or see all my mistakes. And yeah, not all the cleaned up, spruced up, whatever. If I sent this to somebody at Fiverr, I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company. Sometimes I walk alone, and I'm okay with that. Our self-managed closed-end fund, or CEF portfolio, is built on lasting dividends, not the gradual sell-off of own funds. And that means the day-to-day, week-to-week pricing fluctuations don't bother me or weigh on me, or at least I'll be honest, when the market skips, I'm kind of going, why? But it doesn't weigh me down because we're not selling off the portfolio. And that's very different from most market advisors and most investors. So here are the components to our strategy. We play the long game. Now we have some short-term deals. I mean, and those are marked to a degree, but we play the long game. Like, what's the best thing we can do for 5, 10, 15, 20, 30 years down the road? We do not use the investment talk show junkies advice, like the circle junkies that go to Forbes and the Motley Fool and hit every single talk show. We listen, but we don't take their advice at face value. Their 60 to 40 stock to bond ratio concept is dead. It's not built for lasting success in the current marketscape, but it's also just not built for success. 2% dividends get destroyed on inflation. So if you're taking Apple's, was it a meeting the other day? I was at a leadership meeting the other day, and the question was, what would you tell your 18-year-old self? And I took a different stance than everybody, which is fine. I mean, that's me walking alone. My response was, so it was, what would you tell your 18-year-old self in 5 words or less? And my response was, anything I say would not be understood because there's a significant gap between 18-year-olds and me and what I know now looking back, that anything I say in 5 words or less wouldn't make sense to 18-year-old me because 18-year-old me lacks the overall history, concept, everything in order to really understand that process. And of course, someone older in the room went, buy Apple. And I didn't say anything because it's not the place to say anything. But that's really bad advice. Now, Apple's price in general has gone up. Apple pays a 0.5% dividend, and just on inflation. I mean, whether you believe the Fed or not, if with inflation at a pretty near constant 4%, which I get they're going for 2%, but they're going for 2% based on a data table. They're not going for 2% based on your grocery bill. So with inflation at 4% and Apple pays a 0.5% dividend, you're losing 3.5% of your investment every year. So if doesn't matter what their price does, in 5 years, you've lost like 17.5% of your investment. And their price could go through the roof, but you're still losing money every year. So it's not where I would put money. And for that matter, the 4% method, you're going to be in for a nasty shock, regardless of your portfolio size dreams. Like the guy who invented the MIT grad who invented the 4% rule realized that he could not successfully live on 4%. Now he's got a lot more money invested than any of us, but 4% on $1 million is 40 grand. Think of your current salary right now. So average teacher makes like 33 an hour in my area. So based on your hourly pay or um, your salary pay, so 33 an hour, 50 grand a year, it's going to take a while for any of us to hit $1 million invested. But 4% of that is 40 grand. And you're making more than that right out of college. So the 4% itself is inaccurate. And it's a 4% sell off of funds with the idea that the market gains at least 4% a year. And as we've seen recently, that doesn't always happen. So it's more like by the time you retire, on society's terms that you retire. Now, if you retire early on your terms, that's a different matter. But on society's terms, it's at least 8%, which is 80 grand, plus the 4% inflation. Okay, so it's really like 12% of your retirement a year that you're taking out, which doesn't give you a long time in retirement. And if it's you and a spouse, so it's 12% for you, right? 4% inflation, 8%, 80 grand, 12%. If you have a spouse, that's another 80 grand. So that's 20% of your portfolio every year. And if the market comes close to break even, that gives you 5 years of retirement. So that's not retirement. So what's the fix? Is there a counter? Yes. So instead of targeting total, like it's still money invested, right? And we're not looking at Apple and piddly dividends, and Apple's 0.5% dividend for that matter. We target a no withdrawal portfolio designed to fund our retirement. Now, even if we don't hit $1 million, it'll still supplement our retirement. And we're doing that through dividends and not the slow cash out of funds. So when we started, we took the advice of the Contrarian Outlook team. Brett Owens and his team do an amazing job teaching. They are my mentors, whether they know it or not, but they are my mentors. And it's when we were on this journey, which we've been on this journey for about 2.5, I don't know, 2 and 3/4 years, we tweaked the system and refined the search system and made it our own. So instead of getting his missives and reading his cherry picked funds, we wrote down all the funds and sifted through all the funds and put a ton of time into it and then made it our own system. So what is the system? It's part buy and hold, like part buy and we're just going to hold it. And then part of it's rollover. Like we'll buy some stuff and sell it, and then we'll roll the funds back into the portfolio. We don't take the money out. We created this filtration system. We never pay premium. In closed-end funds, it's a closed system. There are a limited number of shares. Now there are a lot of shares, but there are a fixed amount of shares. So it really is supply and demand. But even that, you can get them at discount. So would you rather pay full value, more than full value, like a premium, or would you rather buy at a discount? Like everybody likes discounts. So in our system, it's we never pay a premium, meaning we never pay a premium ever. We target crazy discounts. We use the historical data to improve our outcomes. And meaning like we target crazy discounts. So instead of Apple's 0.5%, we're looking at 9%. Um, we take Warren Buffett's advice. Warren Buffett has a quote attributed to him that says you want to buy stocks for 66 cents instead of a dollar. In closed end fund terms, that's buying something that's 34% off. So if a dollar is break even and this closed end fund is operating at a discount of 34 cents, you're buying it for 66 cents on the dollar. Um, he also says diversification is just a hedge against failure. So having this expansive portfolio with you invested in all these different things like single stock, like all of these different things is overkill. It's we want to choose discernment over outright diversification. I can buy a energy infrastructure fund, several of them that are energy based, energy infrastructure based, and energy transfer based, and utility based, all inside one thing instead of buying all of those things individually. And if I don't like the mix up, I can find another portfolio that's got a slightly different mix uh, or slightly different percentage attributed to each category. I can buy a portfolio in a can who's invested in everything. Um, but we'll get into one of them today. Like you can buy energy infrastructure funds that are solely based upon energy infrastructure, but who invest in equity, which is like general stocks, who invest in bonds and some other stuff. So you have a huge, uh, you have a huge choice, like a huge option or huge list of options at your disposal within the closed-end fund sector, and it gives you access to a lot of other things. And the diversification side of things, the way I explain it is if you read Lord of the Rings and you hear Bilbo Baggins say that he feels like butter scraped over too much bread. If you spread out your portfolio and you diversify too much, you can never make any gains because all of your money's spread out and not isolated or not focused in certain areas. So don't diversify just to diversify and decrease your risk. I also take a Rothschild's advice. When there's blood in the streets, buy. And even if it's your own blood, keep buying. And when you look at that CNN Fear and Greed Index, which is the only thing I watch on CNN, when it's in extreme greed, we need to be cautious. Like if we're going to buy, we're going to demand a discount because we can still get an amazing discount. And if it's in extreme fear, when you're green investors, most talk show circle junkies are going, sell your portfolio because of risk or whatever. When there's all of this fear and stocks go down, the people who sell their portfolios, right? They're in that 60-40 mix and they're selling at least 4% of their portfolio a year because that's how they make money in retirement. Those people freak out because the market's down, they need the money, they don't want to sell low, but you've got all these green investors selling all their funds, dropping things because they get scared, prices plummet. Most advisors will say, wait, let's see how the market responds. And I'm in that to a degree, but I'm not going to wait a long time. Let's see what the market does to a degree. But that's also like when things drop, that's an amazing time to buy because you pick up stuff really low. So based on all of that, where would I park money? So if I'm buying on Monday, where would I park money? So let's look at the market at large. The Fed has stalled rates. I've seen predictions anywhere from three to six rate cuts for the year. Um, and I mean, six seems crazy to me, but I think I don't know. I don't I don't know about three. I would say at least one, maybe two. I would say the first rate cut happens in April, so you get after the first quarter data. Uh, you, whatever they cut it to will effectively spark a real estate market. I don't think the real estate market will come all the way back, but it'll spark a little bit of competition prior to summer. And then I also think they cut rates at the beginning of the presidential cycle because regardless of the economy being good or not, if they cut rates, it makes it look like the economy's good, and most people take the Fed's word for it. And then they can say, "Hey, let us keep our jobs. We've done a stellar job." But what most people don't realize, or most people don't remember, is the Fed caused this, and now they're the ones cleaning it up, and now they're ones updating us on how it's going. Do you think they're going to tell you the truth or not? Um, yeah. So the where would I invest money? So you've got off the first week of the year, but kind of limited week of the year following New Year's, you've got the markets down a little bit, though not a lot. We've been going really well. They kind of it's not a straight reset, it's just a little blip. But the green investors, those 60/40 advisors, are waiting on the Fed to cut rates. Like they're chomping at the bits. And it's like watching the prize fighter in the tunnel bounce up and down, hitting his fist, getting ready to go. And that's how they feel. And so I'm not saying money's not going into the market, but you got a lot of people waiting on what the Fed's going to do, hoping they're going to cut rates, and then they'll buy, hopefully at the beginning of that rally, and then hit the rally and then go from there. But I'm kind of like I'm a cautious buyer at the moment, but I don't think we have to wait necessarily. Um, I do still think we're headed for a recession. Now, when it hits, that's the bigger question. Um, question after that is probably what's going to be the Fed's monetary policy fix. So when does it hit, and then what's the Fed going to do, and how can we optimize our portfolio's performance in advance of that coming recession and in the long term, just so we can weather the storm. Because the idea is that we amass a portfolio that pays consistent dividends. And if we need to sell some funds, we'll sell some funds. But it's really I don't want to say I set it and forget it because I don't want a hands off approach, but it's what's going to do well in every marketscape. And maybe we have to sell some things here or there and we'll circle back to others. But the overall point is dividends plus the overall, I mean, we all want our funds to grow, but what's going to pay dividends now and 40 years from now? So, with that in mind, where would I park money? Bonds were at the top, and they still are as long as you can get a stellar discount. Now, honestly, nothing changes here because we always demand a crazy discount. The slight tone change comes from Bloomberg because Bloomberg finally went, hey, there's a carnival bond market. Sorry, it's drainage, dry throat, and a heater. So, yeah, but you have Bloomberg touting a carnival bond market. It's like, really? It's been going on the last 6 to 9 months. You're finally figuring this out on the talk show. So, with the talk circuit talking about a bond market, it's going to be amazing, and they're pumping bonds. Unless you just get an amazing discount, I would sit back and wait and see how that goes. Um, two would I guess tie for the top, but two would be energy infrastructure still, oil, utilities, energy transfer. Oil and midstream overall still seem to be the most dinged up. Finding the right utility company. I mean, there are a couple great closed-end funds that are costly and not, they don't fit our needs, so they don't make the list. Uh, but I've been able to find some alternatives. Um, but whether you like it or not, oil is going to be a needed thing for our economy for years to come. Because even if you could cancel gasoline, all those solar cars require oil because it's all an oil derivative. Solar panels, fridges, technology, microchips, phones, laptop, anything technology based requires oil or its derivatives in order to make. So we can't just go straight no oil. Then following those two, it's almost everything else besides an outright consumer. Consumer market to me, which I get, like housing is kind of consumer because some people see it as cyclical, but it's really a constant need. Um, Consumer overall is way too volatile for me. So if I can find it in a great portfolio and I can, like a little bit of everything, but it's not isolated risk to only consumer. Um, yeah, but I'm not a straight consumer only favorite or person. The other place I would avoid right now is tech because tech still seems overpriced to me. So everything else would be, I mean, private equity, business development, banks, uh, convertibles, not like the top-down convertible, but stocks to bonds convertibles, data communications, which I get is technology, but it's its own subset of technology. So like data communications, cloud storage, because anything with a microchip from um, the fuses in your car to what's in your fridge to what's in your phone, all of that's technology. Um, but with our ever expanding internet-based society, anything that supports the technology infrastructure for internet, so cloud data, cloud management, communication, data toll bridge, like any of that stuff, um, yeah, much better than outright consumer, like Oreos or um, Oreos, tea, like Lipton tea, popcorn, stuff like that. Because it, if we ended up having recession, which I think we will, um, it's said people will stick to consumer goods, but they're not going to stick to all consumer goods. Consumer goods are like cars, grills, everything food based, but also like phones because that's a consumer good. Now, people will people will skimp on popcorn and Oreos so they can keep their data plans. So I'd much rather invest in data, software, communication, uh, that end of technology and that end of the consumer market than the food market because when I work at a high school, kids will skip meals because whether they have to or not, kids will skip meals so they can play on their phones. Um, and whether you agree with that or not, when it comes to investing, I would rather invest in what they're using as opposed to people deciding whether they're going to buy Oreos for a month or not because they don't know if they can afford it, but they'll pay their cell phone bill. So knowing all of that, where are the bargains, where are the best bargains for the week, and what should we consider? So let's get into that. And thankfully, this is still recording. Hope I didn't just cancel this, but this Zoom format's been finicky. So this is the CEF for the closed-end fund master. It's all 422 different funds. Um, the entire list gets updated monthly. Everything with a color, or maybe specific colors. So purple, green, and blue get updated weekly. Gray, used to be black, but it's honestly easier to update when it's in gray and not blacked out. So gray is not an option. White just isn't color coded. Um, our parameters are these. Well, or at least the target data, meaning so 3 is a buy alert, 2 is a dollar cost average based on what we already have. 1 is tracking for any number of reasons. So the parameters, instead of scaling them by alpha, we scale by discount. And then based on this, we scale them by what I've already done on targets. Oops, targets in reverse. And I could select all of these, but we're only going to look at 3. So we go from here over to this one. Add a column. So current would be what we already own. So we own everything in blue. We track everything in green and purple. So they're all significantly discounted, meaning all of the historical data, which that's happening because there we go. So this discount, like this is what it's worth, and this is what it's selling at. So it's a 46% discount. Now, if we relate it to a dollar would be break even at 0. Anything like if it were positive, so if we go back to the spreadsheet, there's a lot on discount. So if we look at positives, so instead of paying a dollar, you're paying 1.0139 per share instead of a dollar. So you're paying more than what it's worth. Versus this, we're getting everything for a discount and paying less than what it's worth. So 46, almost 47 cents off is we're buying it for 53 cents on the dollar, which sounds obscenely good. Like that's an obscene discount, but it's discounted for a reason. So all of these are discounted for reasons. Don't get me wrong. Like we're looking for obscene discounts. Um, but all of these are discounted greater than their historical discounts, which is what I wanted to show you. So I've gone through and tagged all of these for different reasons. So we want to target discounts that are at least twice as steep as their historical discount and also have a current discount that's greater than their 5-year discount, because you can have funds with discounts that never really close. So the discount is constantly at 10%, and then the last 5 years, something like management change or economy change or anything, excuse me, and then that discount varies. So in order to make the list, they've got to be better than the 5-year discount, okay, which for us accounts for still before and after COVID and that lockdown and then the rate issues and all that. But then it also has to be better than the historical discount. So they're already pre-screened. So by discount, which is why they're all in 3 target or 3 asterisk target. But then we're going to screen by yield. We're going to look for everything that's 9% and above. And the caveat to that are these municipal funds. So that's partly why these are tagged. Not that. HQL is a dividend reinvestment program, an automatic dividend reinvestment program. We own it and we're looking to sell it because so they pay a dividend and then they automatically take it back and they give you partial shares for the dividend they took back. which is nice. I mean, it brings your overall cost down, but it's not a dividend in hand. Like it's not actual, it's income every month that they take back and reinvest it in the company instead of you reinvest the dividend wherever you want it to. Or if you get to that point, withdrawing the dividend. That's not helpful. So it's here and I put it here, but at the same time, it's not going to make our cut. It's still not 9% either. Um, what I'm looking for, so this is a municipal bond fund and it pays a tax equivalent dividend and like a tax-free yield. So I put our tax bracket. So this is what it pays in general. This is what it pays in our tax category. So this one would meet our 9% yield. That one does not, but it's 9%. We'll get to that. So RMMQ 953. I'm pretty sure that's the remaining. HFRO. So here's the deal. They have their dividend and um, crazy discount, but they halved their dividend, which drops the overall yield and takes it out of our pricing, like out of our parameters for this list. Um, it looks like he's restructuring it. The guy who runs this, same guy who runs this company, uh, he's a very skilled tactician. So it used to be bonds and private, like private senior loans, private loans, stuff you and I don't have access to, and very well run. And then the portfolio slowly changed over the last 6 months to a year. And the investments they're invested in now aren't paying like the former investments are, and so they cut the dividend. Now, in reading everything, it honestly looks like he's transforming his portfolio from how he thinks the market will be in the next several years. So I, from my end of things, I mean, we're going to keep the fund. We're not going to sell it. I think the dividend will come back. I think the price will come back. Um, he's gonna. He's run a great portfolio, so I don't see that changing. I just see him restructuring, getting ready for however he thinks the market's going to go. So it dipped, but it takes it um, out of our list for now. But at the same time, I think it'll come back. Um, doesn't make the list. Doesn't make it. 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 These. Sorry. All right. So that leaves us with a short list. So you got to think back to the initial parameters. So a bond fund that you can get with an insane discount, energy infrastructure, everything else except outright consumer and technology. And the other thing we've been working on is targeting consistent monthly dividends. So I'm tempted to buy a fund that we don't own right now. But based on the funds we have available, there is a clear-cut winner for us in this. And um, Brett Owens' latest email encourages caution in the current market, and I concur with that. With the beginning of the year, we're all hoping the market goes better. We're all hoping the Fed cuts rates. And uh, you can say hope or you can say hopium. No one really knows which it is yet. And as tempted as I am to buy a specific fund, which I'll get into, I don't exactly want to buy a fund that we don't already have. So when it comes to buying for tomorrow, me personally, I don't feel a need to invest in anything tomorrow. But if I had to pick anything, I'll show you what that is. And then if we do end up selling our two automatic dividend reinvestment funds, HQL, which is not on the list anymore, and USA, which sounds weird to sell USA. But both of those are automatic dividend reinvestment programs. Now, they both return a lot. Um, Slightly different look if you've seen this before. This is HQL, so it has when we bought it, pricing for each. I really don't want to see if I can move this because I don't want to cut out of that. So it pays well for what we own. You can wrong one there. So I mean, every time they give us a dividend, we get partial shares in return. And what it, I mean, later. And I'm waiting on this dividend. The USA's already paid its dividend, but if we sold these two funds, then I would probably take a chance and buy a fund that I have not seen its like before, but I'll get into that. So, how can I screen these? So, I've heard say municipal bonds pay regardless of the market. That being said, their dividends can change just like everything else. So, is and we don't own a municipal bond. As interesting as these are, you can find better dividends if you really want. Um, but me personally, I honestly don't know enough about municipal bonds to advise myself or advise you upon municipal bonds. So I'm not going to even attempt to do that now. Um, we've been targeting, yeah, we've been targeting monthly investments, and KYN operates a fantastic energy infrastructure fund, um, a fantastic energy infrastructure fund, and they just absorbed their sister company. They actually just increased their dividend. So I love the company, but not looking to add to it at the moment. So to give you context, my goal has been to increase everything we're keeping long term to 200 or more. We had 250 of KYN. It absorbed their sister company in not a one-to-one transfer. So our shares carried over at like 132 out of 150. So it gave us an off number. So since I like buying in sets of 50 and I like it clean and nice and neat, I raised it to 400. So just based on the premise of 200, that would be my option. Um, so that being said, we're not looking to add something that's not monthly. Gabelli operates it's an all stock blue chip fund that's finally on discount, is normally not on discount, but we can outpace that dividend. Even with the dividend cut, it got cut from 0.008, it got cut from 0.084 to 0.081. So Gabelli pays 15 cents per quarter, 0.081 times 3. So you can get 15 cents a quarter on all blue chip stocks, all good stocks, but all like straightforward stocks. Or you can get 24 cents a quarter on utility, real estate, bonds, a better portfolio from my standpoint. Plus, so now we have just monthly. Um, Convertible funds between stocks and bonds. If bonds are going to spike and the time to get into bonds, unless you just find an obscene discount, right? If the time to get into bonds was months ago, then I could kind of argue for and against these funds versus that has bonds and well, they all have bonds. And I can argue for all three. Um, these, we'll do these first. So the same owner, same manager, portfolio cans, right? They have a little bit of everything. This one's heaviest. So as you read through this, it's heaviest on tech, industrial, financial, consumer. This one's heaviest on tech, consumer, finance. Same thing. It's just a slightly different order. But it's that consumer side of things. It's not with tech being oversold and consumer being too volatile. It's just not where I want to go. So that leaves me with this. We don't own any of this. And oh, that's why. And I don't have the money for it. But if we sold those funds, we would have the money for it. It's an interesting fund. I have not seen a fund built on, I mean, read the fund, it's sustainable and social impact. It's all about renewable. They say renewable, but it's all built on oil on the with the premise of it being renewable energy. But it's honestly not renewable because it all takes oil in order for it to make it work. Uh, Me personally, I I am not a solar for urban areas guy. I think it's a crock. Unless your house is routing that solar panel into your own power bank or into your own power bill to offset your AC, all you're doing is acting as a hub for your power company. You're not getting anything for it. Like it might be free to install, but it's not helping you. But I am a proponent of using solar for rural areas. You can put solar panels on a garage to power a pool pump or part of a house's electricity needs or electric fence, any number of things. You can kind of piecemeal your whole grid if you really had to, but it's still all an oil byproduct. So to have a fund built on oil, built on renewable energy, but also built on solar and have it spread between stocks or equity and bonds and some other stuff like preferred shares, it's I've not seen its like before. It's kind of interesting. And I wouldn't hinge a whole portfolio on it, but I would buy 100 shares and see how it went. But that being said, we don't have the money for it right now. So it's an interesting tidbit and something to keep on the list, but also something not to buy right now. I can argue for either for I can argue for these. They're convertible between stocks and bonds. With the bond market up, the stock market blipping, like they're well placed. And regardless of what the economy does, the banks are going to get their money. So, and as much as people, say as much as a lot of people hate banks, they need the banks because of we all need money. Um, this would be my choice, honestly, just for what it has. Real estate, energy, utility, bonds, all set to do well in any economy. Great for now, great for later. This is a sister company to the other Highland Fund, HFRO, who cut their dividend. So they both saw dividend decreases. This one did not decrease as much. Um, and that's what it was. That's what it is now. It did not change that much, but it did decrease a little bit. But it goes back to the Rothschild quote. It's buy when there's blood in the street, even if it's your own. And we are invested. And the dividend cut doesn't kill us. It is a little bit, a little bit less than we are expecting every month, but it's still the best choice. Long run, I think the company comes back. It's well placed to come back, whether we hit recession or not. So if I had to buy tomorrow, I would do that. But we don't have to buy tomorrow. Therefore, I would wait, me personally. I'm curious how the financial data coming out of the first full week of the year goes. Um, Inflation data is projected to rise, which would mean the Fed will not will not decrease rates anytime soon. And honestly, if the inflation data continues to rise, as much as people want the Fed to cut rates, they're not going to cut rates. So eh, between what we know of the market, Fed wise, of what we know of the market, um, drawn a blank with it being later, but the with it what we know of the market as it relates to the Fed, but also of what we know of the market overall for bonds and everything else. Um, Stop the share. You get to see my tired face. Um, yeah. So whether the Fed cuts rates or not, whether the recession happens or not, that specific portfolio, HCLB, is placed to do well in this market or in that market. And with I want to say his name is Dondero, with him restructuring the HFRO portfolio, the dividend dip and the cost dip in HCLB, um, it, it seems that they're going to restructure both a little bit and prepare for the coming market. So based on our overall price, I mean, HCLB is a great dollar cost average for us. Yes, we own it. Yes, the dividend went down, but it's still the best investment for us in the current market. That being said, even though we can buy Monday, I don't feel the pressing need to buy Monday. I've used this analogy a lot today. When you face big financial decisions and when you face big decisions in life, there are some decisions that just come easy. Like whether you prepare for them or you pray for them or you think it out in advance and you plan for it. And when it finally happens, it's just smooth sailing, easy. No hesitation, no fear, no anything. And then there's other times where you're doing something, and it could be little or big, doesn't matter, but you do it and you're kind of moving towards that option. And you get to a point and it's like, I can't put it into words. I can't explain it. Like I could take a long time and weave in and out of stuff and still end up in the same spot of not really being able to explain it, but it just does not feel right. Like there's something about it that just doesn't sit well. I can't put a specific finger on it. I can't frame it, but I can't like it doesn't feel right. And that's kind of where I am with this. I would follow Brett Owens. Be cautious. If you don't have to buy, be cautious. And if you have to buy, be cautious. And that's where our system works because we demand a discount and not just any discount. We demand a significant discount based upon the overall historical data. So you get the best possible discount, the best possible deal for your money because what you have and where you're investing matters. It's not the dollar cost average. It's not like we're buying here, right? We buy next month and we're here. We buy the month after and we're there. So right now we have this average. If we average it, great. But we're buying the discount and we're buying the dividend, and then we're buying based on whatever other parameters, monthly, quarterly, this market, that market, whatever. But we are prioritizing the discount and using that as our primary filter. And then we're taking in the historical data in relation to the discount and using that. And then we're taking the overall yield and we're managing that. And then we get to figure out where we want it, monthly, quarterly, alternating quarterly. Um, and then after that, we can sort it by sector, right? So bonds, energy infrastructure, everything but consumer and everything but outright consumer and technology. And then we're targeting a specific investment and we're optimizing our investment. We're optimizing what we're putting in and we're optimizing what we're getting out. And if you have to buy, you're still following the same system. And if you don't have to buy because you can't explain it, but it just doesn't feel right, then that's okay. Then you wait, you reevaluate, adapt the strategy if you need to, and then you keep going. Like maybe you wait a week and then you go from there. For us, we're not buying tomorrow. If we had to buy, we would buy HGLB because that's the best strategy for us right now. If we sell those funds and we end up with more money in that account, then I'm willing to consider something we don't currently have and consider not betting the whole farm on it, but at least consider 50 to 100 shares of it and to see where it goes. So those are my picks for the week. If you like the information, please hit the like button. Please like my channel, subscribe to my channel, and then head over to Facebook and join my group there called Navigate Your Finances. And that information will be in the descriptions. As you go forward for the week, whether you buy or not, hopefully you have a strategy, but whether you buy or not, you are the captain of your ship. So make sure you know where you're going and why, because that ship will go wherever you steer it. And as you face the week, as you face the beginning of a new year, your dreams are there and you can reach them. And it's possible to make progress towards accomplishing those dreams. But whatever your dreams are, none of those are going to happen on their own. Because if they would have happened on their own, if they could have happened on their own, they would have already happened on their own. So you're going to have to make a decision somewhere along the way for those things to happen, even if you have the money. Like, I want to go skydiving. Do you have the money? Yes. You're still going to have to make a decision to go. So whatever it is that you want to do, whatever it is that you're dreaming and hope to one day do, make it happen. If it could have happened and it would have happened, it would have already happened on its own, but it hasn't. So make it happen and pilot your ship, navigate your ship towards those dreams and beyond. And your ship, seriously, your ship will go where you steer it. So make sure you know where you're going and why. If you have no idea what I'm talking about, it seems like I'm speaking gobbledygook, then head over to Facebook and check out my Navigate Your Finances page. And I get into all of that on that page. So whatever you have for the week, I hope you have a great week. And if you have questions, ask me in the video or ask me on the comments, and then head over to Facebook and find me on Facebook. So have a great week, everybody. See y'all on a different video. Bye-bye.